Hey, it's Kurt here, financially independent real estate investor. I'm on the roof of my house this Tuesday afternoon recording this video intro for two reasons. The original intro that I did for this video sucked, and also because right now there's no other place that I have to be. The well-managed 27-unit real estate portfolio that I built, the income from which you'll learn about in this video, ensures that my needs for today are met. I don't have to be at a job today because I took action, leveled up, and quit that. Instead, I can record this video on my roof. An online presence through this channel and potentially other outlets could help to ensure that my needs for tomorrow are met, provided that I succeed in offering consumers of my content. That means you, genuine value. So that's what I'm here working on. I'm grateful for the actions of my past self, deciding to build a real estate portfolio while working full-time as an engineer. Now it's on today's version of me to pay it forward and do things that future me will be grateful for. What are you doing for your future self? Hopefully I have an answer for that, but either way, I have a good option for you in this video. I'll break down what Cashflow is, why it's superior to active income, and what I did to surpass 10,000 of it per month, which comes reliably, even while sitting on my roof. This video isn't just about hypotheticals. You can get that anywhere, but I reveal my personal stats later in the video, which I've never made public before. So if you value this kind of authentic content, let me know by smashing the like button for the algorithm. The work-averse amongst you are probably salivating at the thought of clocking loot without having to lift a finger. And if that's you, you might as well just switch off this video now and have a wink instead. It'll be about as productive. The truth is that this alternate reality of financial freedom doesn't happen by accident, but rather with extensive learning and sustained action. For those of you living with purpose, willing to put in work now for reward later, the first step in this journey is a simple mindset shift. Instead of working for money, you work to build and acquire assets that will make you money. Let's be real, you probably already knew this, at least on some level. A pretty standard career arc is to work for like 50 years while gradually investing in stocks and bonds or whatever, and hopefully you'll have enough come retirement age to live off of the yield. What differentiates my path from the norm is that it didn't take me 50 years to acquire enough assets to live off of. I did it within 2 years of setting my mind to it, and then quit my job. Now, 3 years in, I net over $10,000 per month in cash flow from my real estate alone, which is more than double what I took home as an engineer after taxes. So this is net income versus net income. It's basically an apples to apples comparison if you neglect the fact that with real estate, I'm also enjoying principal paydown on my loans and appreciation from a low seven-figure portfolio. And let's not forget all the equity that I've forced into my properties through making improvements and managing them well. That blows the old 5% employer 401k match out of the water to a hilarious extent. I'm not sharing any of this to brag, but rather because I sincerely believe that the less sexy info that I'm going to share in the rest of this video will offer you significant value if you are somebody who aspires to be financially free. And if I don't establish myself as an authority on the subject, you wouldn't trust me, and for good reason. So yeah, new channel, not a lot of views, but the numbers that I'm citing lean towards the conservative side, and I'm the sole owner of these properties. Hopefully I can get you results and earn your trust. Now, onto some basic definitions. I mentioned the word asset previously, and it's a word that's often misused by people who buy expensive things that don't actually make them money. An asset is something that makes you money. Simple as that. Lots of things can be assets, like certain watches or cars that savvy buyers can recognize as items that will appreciate during their span of ownership. From a practical standpoint, you're not going to be living off of unrealized capital gains, which is what the appreciation would be without a sale. And if you're flipping those items for income, you have a job, and that if you stop flipping them, your income dries up. Cash flowing assets are what we care about for the purpose of financial freedom. Appreciation is just gravy. We need to define cash flow and differentiate it from active income. Active income, as the name suggests, is income that you receive from performing some sort of task. Your time times the value of your skills equals your income potential. Active income can be grown by either working more hours or by increasing the value of your skills. Your time is an input in the equation, so you're not getting paid while you sleep, hence why this income is considered active. For the sake of this argument, we'll exclude the possibility that you have an audience of weirdos who will pay to watch you sleep. New OnlyFans niche. Look into it. Cash flow, on the other hand, is not tied to your time, but rather the value, productivity, or desirability of your assets. Let's say you have a house, and this house is a desirable house that people want to live in. Well, somebody will be willing to pay you rent in order to live in that house. If the rent that you're receiving for your house exceeds the expenses associated with owning and maintaining that house, congratulations, you're earning cash flow. Your time isn't part of the equation. You, of course, have an obligation to maintain that house to a certain standard, but as long as that's happening, it doesn't matter if the work is being done by you, contractors, employees, or your personal army of clones or robots. Depending on the lease, the tenant could even be responsible for everything, including the structure. But that's not common with residential properties. That's more of a thing for commercial. Triple net leases if you want to look it up. Now we know that cash flow comes from assets, whether they be real estate, shares in a business, paying dividends, or any other widget that you can rent out for a positive net return. Cool. Now let's pull back the curtain on what I'm doing. Although I do own some dividend stocks, which do provide me with cash flow, the vast majority of my cash flow is from residential real estate. I currently own 27 units of rental real estate, 21 are rented out, and 6 are in the final stages of undergoing improvements and will hopefully be rented out soon. All are in the Detroit area, within 30 minutes of my home in Farmington Hills. The rents for these units range from $750 a month up to $1,700 a month. The cheaper stuff accounts for less of my portfolio, being units that came occupied when I purchased properties, where I've been gradually easing up rents while still keeping them competitive for their respective markets. I aim to give established residents a slight discount to reward them for sticking around. Good for them and keeps my turnover low, which is good for me. Most of my portfolio consists of higher-end, recently rehabbed units. That is a product of my general investment strategy, which involves buying distressed properties that needs work, making them really nice to force a lot of equity and command high rents, and then doing cash-out refinances to access the equity that I forced. That money then funds my next deal, rinse and repeat. This is commonly referred to as the BRRRR strategy in investing circles, standing for buy, rehab, rent, refinance, and repeat. I'll do an entire video, or likely several in the long term, that goes in depth on this strategy and includes real examples of deals that I've done, how I forced equity, and their accompanying numbers. This is an amazing way to scale rapidly without needing a lot of money to inject in your portfolio. It was my main enabler for achieving financial freedom at 31, and I can say with high conviction that it would have been achievable in my 20s too, if I had known what I know now sooner. Now is a good time to subscribe and turn on notifications if you're looking forward to those insights. Across the units that I have rented out, I gross a little over $25,000 per month. Renting out the additional 6 units that I just rehabbed will be huge, and that it will yield me another $7,600 approximately for a total net income of $32,600 per month. Of my gross income, I keep around half of it, even with the 6 units that aren't rented. On average, after paying principal, which just creates equity, interest, taxes, insurance, and maintenance, I'm left with around $12,000 per month. That's pretty typical, but I still cited $10,000 as the figure for my cash flow because if some big maintenance event comes up, like a property requiring a new roof, I'm obviously going to be profiting a lot less that month. So averaged out, the $10,000 figure is probably more realistic. I also have utility expenses with some properties, lawns to mow, and some interest to pay on a couple of credit lines that I use to buy and rehab properties. What's kind of mind-bending to think about is that the revenue created by renting out my additional 6 units will be almost pure profit. Renting them will only marginally increase my operating expenses. That means that the extra $7,600 or so that they'll produce will nearly be pure profit, resulting in a total net cash flow of around $17,000 per month. Of course, once I refinance and pull equity out of the deal, my debt service payments will be higher, resulting in a bit less cash flow, but I don't really care because then I'll be getting many hundreds of thousands of dollars to go buy more money-making assets and do this all over again. But yeah, once you understand that a lot of your costs will be there no matter what, the value of keeping your units rented becomes crystal clear. The cost difference between maintaining a vacant unit versus an occupied unit is pretty insignificant, so keeping those units rented and finding other ways to monetize your properties while keeping the expenses that you can control down really juices your bottom line. Portfolio-wide, I don't have anybody who isn't paying because I screen carefully and then strive to deliver good and prompt service so that there's no question as to whether I'm fulfilling my side of the bargain. Fortunately, most issues can be solved in short order with a simple phone call to a trusted contractor, so I strive to solve all issues in short order. I'm pretty handy, so sometimes I'll get my hands dirty and fix things myself. Being handy helps with my margins, and some DIY repairs may be necessary when starting out in order to save money, but it becomes optional as time goes on, allowing you to focus more on higher value tasks. My margins are also higher because I self-manage my properties, which takes a lot less time than one might assume. For reference, professional management seems to cost around 8 to 10% of gross income, at least in my area. Here's a table that shows my gross income for each of my properties, as well as what I'm paying for principal, interest, taxes, and insurance. Obviously, there will be other expenses too, but these are the main ones. For multi-unit properties, I collapse the income from all the units down into one line. It's also worth noting that I live in one of the best cash flow markets in the country, and even within my market, I am achieving larger spreads than most. I'm not saying I'm some genius doing things radically different from what others are doing, but I am willing to take on projects that require a lot of work, and my underwriting process is probably unusually harsh, so I turn down a lot of deals. But I'd rather underwrite pessimistically and revel in greater than predicted returns than underwrite generously and be screwed when the tides of the market shift. I've maintained my living expenses at around $4,000 per month for the last several years, so I have a surplus that grows as my income grows. My intention is to keep my living expenses flat until I'm living off of 20% of my net cash flow, and then allow my expenses to grow with my income, maintaining the 20% rule. But Kurt, why would you do that when you could buy a sick Lambo with your surplus income? I mean, it'd be sick, right? Wouldn't it boost your channel, bro? To that I say absolutely, but I'm more focused on my long game, and I've said for years that I wouldn't buy a supercar like a Lamborghini until I can afford to drive said Lamborghini into a swimming pool, buy a new one, and then go about my day as if nothing happened. That's way more sick, bro. But when the day comes for me to drive a Lambo into a pool and immediately buy a new one, it'll make for a pretty solid video if Whistle and Diesel doesn't beat me to it. In the meantime, I already own a Miata that passes McLarens on the track and outshines Lambos at car meets. I'm a fiend for value, and this thing punches well above its price. Generally speaking, my surplus income goes into growing my portfolio. I use it to help fund rehabs in order to force equity, which I can then access via cash out refinances in order to buy more properties. While this video is intended to open your eyes to the many benefits of investing in real estate, the simple act of investing in real estate will not inherently deliver the results that I described. Not all properties cash flow. Some will eagerly drive you into poverty. My numbers are unusual, but obviously not impossible. Most people need a lot more units to make the money that I make, but the goal is to make money, not just to have a lot of units. And I've chosen my deals accordingly. I also have a lean and mean operation with very little overhead. I've achieved what I have through a sustained commitment to building knowledge, thinking critically, and remaining ruthlessly objective when it comes to analyzing deals, and executing to the best of my ability. Real estate is also a people-oriented business, and the simple act of treating others the way that you would want or expect to be treated may honestly be the single most important factor for success. Your probability of success is high if you can make those same commitments. In addition to videos like this one, that are more geared towards turning you on to real estate investing, financial independence, and the attainability of both. I'm also producing a series that will give you foundational knowledge to really understand the nuts and bolts of real estate investing. The whole process of real estate investing, from finding deals, recognizing opportunities to add value, underwriting your deals, performing rehabs, property management, and navigating the array of possible loan types and deal structures, can be intimidating at any level, and sucking at any of those components can hold you up. The best way to not suck is to arm yourself with knowledge, think critically, and learn as much as you can from people who are out there doing it. If you want to check it out, I have a playlist on my channel called Real Estate Foundational Knowledge that contains those informational videos. I'm going to try to crank out a couple of them a week until it can serve as a standalone source to help new investors thrive. Watch them all a few times to get the most out of them. They are dense. Take notes and bookmark for future reference. And then hit your first or next deal out of the park. As always, thank you for watching and have a great day.